Hi, as I mentioned, my name is Homa Souratian. I am a mortgage agent. I have more than 15 years experience in real estate and the mortgage industry, starting from Dubai, UAE, continued in Canada. Today I'm going to talk about the commercial mortgages and versus residential mortgages, also commercial real estate insights from a lender's perspective. At the end of my presentation, my friend Saj will answer your questions, and especially about the underwriting parts. I really advise you to ask all of your questions regarding the underwriting. It's very complicated, and no need to mention that Saj is one of the top experts in mortgage, in commercial mortgage in Ontario. Me and Saj and I together work on your commercial mortgage inquiries. So, at Integrity 3 Financial, we are partnering with different lenders, big banks, monoline lenders, private lenders, also the credit unions. We ensure you, we just take your deals, help you with the best deals and best rates. We are supporting you with your commercial mortgages, residential and your commercial loans. Also, we are offering you very seamless, transparent, and no stressful process. It's very important, especially when you are dealing with commercial mortgages. It's full of stress. Integrity 3 Financial is a part of Pineapple Network. Pineapple is an award-winning company regarding the digital innovation and regarding the support that we offer to our realtor partners and their clients. I will give you more information if you need more details after this presentation. Talking about the commercial mortgages, the mortgage market in Ontario really divided into two major directions, residential and commercial. I know that today we have many of our friends are experts in commercial. We have some other friends that they are experts in residential, and this session is recorded. It means that people in future also they watch this video, and maybe this information can be helpful for them. So, talking about the residential mortgage mainly finance on the properties who owns by the individuals or families. This property is for owner-occupied or for the people who just want to rent these properties. Commercial mortgages deals with finance the properties that they are income-producing properties. Who are the borrowers? The borrowers are investors or corporations. Meanwhile, commercial mortgages are very complicated most of the times, extremely specialized regarding the underwriting parts or regarding the rules or the policies of the lenders. They are usually larger mortgages and more riskier for the lenders. This is one of the most important questions that usually our friends in residential part ask us. What is the major differences between a commercial and a residential mortgage? Obviously, subject properties in residential mortgage are income-producing properties. They are such as, for example, apartment buildings, office buildings, retail centers, and others. Lenders deeply look at the financial income of the borrowers. Also, they are analyzing about the property itself. What is the income of this property and what are the expenses of this property? And also the lenders that lend these commercial mortgages can be banks, monoline lenders, credit unions, and private lenders. Each of these lenders, they have different criteria. They have different rates, policies, and they are trying to just adjust the product somehow that they can answer their target market and their clients. Commercial mortgages have a loan to value. It can be up to 95%. It can be as low as 40%. It depends on the property. it depends on the location of the property and many other lenders. Also, if it goes after 80%, 100% CMHC will be involved. Let's talk about the appraisal, ESA, and other aspects. Property itself is very important for the commercial lenders. Regarding the appraisal cost and appraisal time in commercial mortgages are very different to residential. Appraisal costs start in commercial mortgage from $2,000 up to $50,000, and timing can be almost maybe 3 months and more. Please don't forget that when we order an appraisal for the commercial mortgage, we should always consider and ask all the specifications that we need from the lender to be considered in this appraisal. And because sometimes appraisal comes, but it's not enough, and it cannot convince the lender regarding the information that they needed and they required. And the appraisal most of the times comes less than what we expect. The recent appraisal that I ordered for a plaza in the Niagara Falls, we just expected the price would be $2.2 million, but the appraisal come 1.6. It was so much less. So in this case, which we cannot always think that what we think it would be what we receive from the appraisal. ESA is environmental site assessment. Most of the times, lender before the financing need this one. Starting from the phase 1, it has 3 phases: phase 1, phase 2, and phase 3. Phase 1 is more simple. They just go to the property, look at the site, look at the map, interview the tenants sometimes, and check the documents. But if there would be any point of concern for the lender, they may order phase 2 or phase 3 of the appraisal. Phase 1, phase 3, they will go much more deeper, and they try to take sample from the soil, water, plant around the property, or they might go inside the infrastructure of the property to find out is there any impact from this property to the environment. This takes a long time. For the phase 1, it is around $2,000, but phase 2 and 3 start from $1,000 to $100,000, depending on the property and the property itself and how the process will go. Timing, regarding this much of inquiries, so in this case, timing would be start from 3 months most of the times and may take 1 year or more. Of course, case by case, it will be different. Interest rates on commercial mortgages fluctuate based on the market conditions, the property itself, and credit history of the borrower. All of them together convince the lender that how can they fix this interest rate for this specific case. Meanwhile, we should mention that in major cases, commercial mortgages are fixed rates. For the construction, it can be variable rate. Here I list some of the estimated loan to value for different properties. We can see that all of these numbers are estimated numbers. So it can be changed case by case. We can see that it can go up to 95% when savings is involved, or can go low as 40%, according to our experience and the client that comes to us, and what we found from the market. The farmland or vacant lands are almost close to die in this park. Again, when we are talking about the interest rate, it's fixed most of the times, and construction variable. Amortization can go to up to 50% depending on the case by case and involving CMHC. In general, we cannot say that any property is favorite for the lenders. It really depends. But however, we can say that if a property is making enough income, producing enough income, and has lower risk, so it is convincing to the lenders to just be involved and have mortgage on that. For example, as my friends also previously mentioned, multi-family properties, buildings, also retail centers or industrial properties can be some of the favorite properties for the lenders. Why? For example, multi-family properties are always a high demand for that, and there is always an expectation of high rental income. Or retail centers, for example, malls, if they are in a good location, they have different tenants from small or big or larger clients, so they can predict more revenue. It would be safe for the lender to mortgage on that. And also industrial properties such as warehouses or distribution centers, because nowadays e-commerce is growing. Also online shopping. So this manufacturer, they want to have some distributor center close to their clients. So in this case, we can see industrial properties are one of the most favorite nowadays for investors and for the lenders. What is important for the lenders? Lenders deeply look at the real estate market, deeply analyze the real estate market, and according to that, they want to make an informed decision about their products and manage the level of the risk. It's very important. For example, they check market trends, they analyze market trends. Why? Because they want to find out what is the demand and supply, what is the vacancy rate, or what rental prices. And then they will understand how healthy is this market, how much would be their risk. Meanwhile, property type are very important. Don't forget, the rules that are applying to the offices are different rules that apply to the residential properties, buildings, or the rules that apply for the industrial properties. So lenders should know all of these rules when they want to lend to each and any of these properties. It's important to them. Another thing is borrower profile. It's very important. Not only borrower profile, but also the property profile. How much would be profitable? In borrower profile, it's important because they want to understand how financially this borrower is stable. What is their business plan? What do they have in their mind? What they want to do? Will they be able to just pay back the loan? It's the main concern of the for the commercial lenders, especially nowadays. And any changes in the rules and regulation in commercial industry or in whole real estate industry will directly affect the decision that the lenders may take to just make their products or offer the rates or offer other conditions. So they watch closely these rules and regulations in the real estate market. Also, they should watch closely their competitors and their products to stay and be competitive. And economic data obviously is very important. GDP and the unemployment or employment figures, some signs like this, because according they will understand that how this business in this market doing. Are they able, for example, to rent an office? What will happen in different part of the commercial mortgages if they don't have this information? Here, we just try to understand what's commercial lenders' greatest concern. This survey was from Q1 2023. The greatest concern was the predicted economic recession, continued high interest rate, and global events such as wars that really affects all the economy in the world and especially our country. This is just overview and update on this survey prepared on second quarter of 2023. It talked about the GTA commercial real estate market, which says that GTA commercial real estate market continues to slow down. There is something important that I want to just mention in this explanation. This presentation is available if someone wants to go further and just read it again. The point is that as we find out in the market, according to our experience and according to that we find out in the market, don't forget that we are not researchers. We are mortgage agents. Our job is not to give you advice regarding what is a good opportunity to go to invest. It is something that related to the researchers departments or people or real estate expert that they are doing commercial real estate. Our job is to talk about the underwriting part. What you need to prepare to the mortgage lender to convince them that you are a good candidate for this loan. But having a general idea is also could be helpful. So, as we understand, industrial properties, the apartment building and retail centers are doing well. But, for example, we can see that office vacancy in whole Canada, especially in GTA, jumped up to 18.5%. So it starts, in general, what's happening right now in the market in GTA and Toronto. And also don't forget that the continued high interest rate, labor shortage, geographical issues may make it harder for Canada to avoid the expected recession. Recession is something that is the main concern of the lenders, even for the investors. GTA transactions, we can see that GTA transaction in all sectors decreased by 25% comparing last year to this year. This is a general idea that we can just ready to offer. It is something that obvious and which, that make concern. Here, in this chart, GTA property transaction by asset class. As we explained before, this comparing 2 years, 2022 and 2023. You can see that the industrial properties doing well. After that, there's apartment buildings, and then we can see the retails. I hope you find this presentation informative. And now I thank you for your time, and now I want to ask my friend Saj to come here and take your underwriting questions.
Thanks, Homa. Any questions so far on underwriting? Anybody have deals on the go? No deals on the go? Well, this is good. This presentation for you guys to get deals. All right, so what we're finding on the broker side is obviously from the data here and data from M&M, there's a contraction on many things, right? Which is obvious. I like contractions because what tends to happen is the clients we couldn't get that were in the banks are now reaching out to me. They're saying, hey, Saj, I'm not debt servicing now because the banks have something called a DSC, right? So they have to meet these stringent requirements, and if they're out of covenant, which is in their mortgage contract, either they have to plunk in $1 million, $2 million to be back to normal, or they have to do something else. So we're finding bridges for them in the interim. So they'll come to us now, which is great because we never could have got these clients. We are out there contacting them and never get them. Now they're coming to us. So what does it mean? There's an opportunity for us to basically do the bridge, and then basically now we're open to go to any bank or any lender for them when they have to negotiate maybe a better rate than they had or better terms that they had. So it's a double hit for us at this point. So a downturn is not always a bad thing. It's actually a good thing. So we've got another client that's built, I'll skew the numbers, but let's say they built 25 townhome complexes in Southern Ontario. So they bought the land in 2021, which is at the peak, and then they basically started construction. They didn't halt the construction, which would have been probably a wise thing to do when the interest rates started to increase. But they went right through it. So now you have a complexity that would come to us to help them out. They've started with a private, they had 3 tranches, which means, let's put it this way, they've got 3 registered charges on their title. That in itself is a problem, optically. Okay? Even though it's with the same lender, it's optically for a construction project is a problem. What should happen in a construction project, you should budget the construction, get one loan, and within that first charge, do tranche that loan. That's the proper way to structure that. Which they didn't. So now it becomes a very difficult thing to convince a lender that, hey, this is not a distress situation. Technically, it is a distress situation. I did tell them that, but I didn't like it. But it is what it is. And that's exactly how people are going to look at it. But that's why they need us. That's why they need the help to see where we can place them. So there are things like that that are going on. They need extra money to finish the project. There was cost overruns in the project. GC here is managing, but I don't know if they're managing well enough, if there was cost overruns in the situation. But now, when they got the loan, it was pegged for 2001 appraisal. Now it has to be discounted. And what that value is today is it's the most difficult thing. So some units are selling for 800, 900,000 per townhome. Okay, even more. There's like a 2,000 square foot unit in let's say Niagara region, which to me right off the bat is too big for a townhome, too expensive when you can almost the same thing over here in the GTA now. So this causes a major issue. So we're working on someone like that and trying to help them. So as realtors, you should look for these type of opportunities. Even if a project's coming up, it doesn't mean that they may not need your services for something, and you can do the takeout on those units as well. So having that, is there any questions around that I can help you with?
So how do you overcome something like that?
That one is very difficult to overcome. So basically, I'm trying to restructure it. I have contacted a couple of lenders. Now, this is going to be private again, right? There's no way I can go institutional. It's kind of like they may just break even if I'm lucky, at least not losing. So what I want to do is to see if we can amalgamate all of those debts into one, and even with the same lender they're at. So now optically it just looks better, and then I can see if I can take them out, or I can find another second behind that to get them through the construction phase, finish it, and then either they rent it out and hold for now and ride it through, or try to sell it and see if they can break even. So it's going to be one of those suggestions I'll make to them, and it's up to them which way we're going to go after that. So some situations are very difficult to overcome. If the structure is not adhered to, don't come to us and do the structure at the beginning of things, then it ends up in these type of situations. And of course, our service is free until we're performance-based like you guys, right? So if we don't close it, we don't charge. There's no point in us charging on that. I don't believe in that. I don't believe in upfront fees.
Let's imagine that somebody interested in getting into commercial real estate on the multifamily side of things.
Yeah.
They're looking at a property in West End Toronto. It has 15 to 25 units in it. Let's say it's $7.5 million. What would be the process involved in them being able to secure a loan against that, and what would be the percentage that they would need to have down to be able to qualify for such a purchase?
It varies. So what we do is we do it with a residential license. I try to teach my agents on that. Do the work ahead of time before you go out and sign an APS, right? Very important. You know where you stand, because once an APS is signed, and the legal will tell you, you're kind of, once you waive stuff, you're really screwed, right? So same thing in commercial. We'll do, and we do it we have agents that are realtors in our brokerage. So we will do the pre-calculation for it, an estimation, right? Doesn't mean it will be that. It depends on the lender, depends on the economic environment, everything else. So they'll have an idea what the cash flow is going to be. Cash flow is not linear. So when you do commercial, it's not linear. We stick a bunch of nonsense in there, and then we discount everything, right? And the stuff we may stick on, it'll vary depending on location, depending on the unit, depending on the building condition report and all of that. It'll change. So it's not something we can just peg right off the bat, like here's the interest rate, it's not like that. So that's number one, to get a pre-analysis done, which is free. We do that for all of our relationship building relationships. Second thing is you have to remember, if it's multifamily, anything has to cash flow. So if there's an opportunity in that building to expand it, maybe there's one unit with 3 bedrooms, but you can separate that into another bedroom, providing the zoning is permitted to do that. That's an opportunity. So we can go, instead of a prime lender, we can go to a sub-lender. You get that stuff done, and then we look at taking out with a better rate, a better system. So sometimes in commercial, it's not always A to B. It's basically A, B, and then back. B, sometimes C, combination of that, and then back to A, type of thing. So we play around with which may be the best opportunity for a client. So for example, I have a client, she owns 2 mixed use on Eglinton, right? great, mixed use is perfect, it's like the staple of the city, right? Everywhere from corner to corner, when you go down those roads, it's there. What she wants to do, she's got the second floor empty, first floor is commercial, obviously. She wants to renovate all those units, they're empty right now, and build another stack on top. So starting from 4 units, you can put 1 more on the second floor, and then another 5 units or 4 units on top, depending on where the escape is. That's a little tricky, because now she only has 1 income on that property, right? So, but we can go to lenders that will use projected rents on that. Complication becomes, yes, the equity's there, she's got another unit there, how am I going to convince the lender that she has equity to put in? Because everybody has to have skin in the game. The first thing they're gonna ask me, how much have I gonna put in? Right, because they don't want you to just walk away. But no one's walking away from mixed use properties on that. But it happens, I've seen it, it does happen. So I will basically see what the lenders are and their appetite for doing that, considering it's a negative DSC, right? And how far the negative DSC is also an issue. Her experience on that, she doesn't have construction here, but she has to hire a proper GC, to make general contractor, to get that thing done. So I will maybe blanket the second property, to make the lender more comfortable for her to do that. Now, there's a mortgage on the second property, but there's still equity on that part, so that's fine, they'll probably be okay with that. So as long as they're okay that, yes, if we have to, like any lender will look at one thing, can we liquidate this property? Are we gonna recoup our money, are we gonna pay our investors back, right? And ourselves and the legal costs and all of that. It's expensive, that stuff is not cheap, right? So that's the number 1 thing, so we have to shore that and provide a mitigation to that. So that's an example of that. But same thing with multifamilies, they're still good, the demand is huge, but what tends to happen is people asking a valuation for that property is not supportive of the rents. Especially if they have tenants in there already and are grandfathered and they're paying $1,000, but you can get $2,000. You can't kick these guys out, right?
So what's more favorable, to have the vacancies?
Oh, yeah.
You can get into more
Oh, yeah,
rents?
100%.
Yeah.
Yeah, I did a building, I used to work for Equitable too, but I think it was like a 25 unit building, somewhere in the downtown core, well, off the downtown core. No tenants, a couple of them, they were just planning to kick them out, I guess pay them to leave, let's put it that way. And it was no income at all. So we did the loan, I did the loan. But it was big, it was like $8 million, okay, back then. So there was a bunch of renovations, we have to see, do they have the money for the renovations? Who are they using for the contract for renovations? What are the market rents on, as a complete basis for those things, and will it cash flow after that? Right, so these are the things that how long is it gonna take? Now, the thing is, you have to have enough money to pay the bank their money every month. You have to have enough money to put down on the construction / renovation project. Can't say construction, that's a big no sometimes. So we try to say renovation as much as possible, but sometimes we can't help. But so all these little factors play into account. And can the person go directly to like a bank and try to do this? Sure, they can try, right? But then if they present things they shouldn't be presenting, or they say things they shouldn't be saying at this point in time, it's not to say they should lie, but there's relevant information that the banks, every lender wants to just see the relevant information. Wants to see something they cannot take it back. And I'll tell you this, being the head of credit for a bank, chief credit officer, I used to tell all these account managers, do not send us something we're not asking for, right? Because we're asking you for a particular set of things for a particular set of reasons. So, and you need to know what that is and why they're asking that, right? That's the key thing. A lot of brokers in this business who commercial don't know why. Because there's policies and regulations, there's OSFI stuff and requirements that there's a reason that these things are asked. Sometimes you test it. Sometimes it's test to see if it's legit. Because I used to do that a lot. But anyway, these are the kind of things. So the key thing is to be able to mitigate the purchase or mitigate refinance before it gets to the lender. That's the art of commercial, right? So, but that takes experience.
Yeah.
That takes a lot of experience because I've seen pretty well everything cross board. I have one client that's $60 million worth of guy. His is the most complicated thing I've ever had. Trusts, blind trusts on top of that, owning some companies in here, that own this holdco, but you can't take the blind trust as the guarantor. You have, it's a very difficult deal to place. And we place it, but it's epic. If I could give that client away, I would, but I can't. So, so it's one of those things, and that's like a private banking level. They have sort of looser exceptions they can make to those guys, right? But because he doesn't want to bind the trust, that's almost a no-no everywhere, right? But unless you're like on the Maple Leafs and people like that can kind of get away with it. But we got it done. We got this guy done. But there's a limitation on how much we can do for certain clients.
So
Yes.
in residential right now, there's retractions across the board.
Yeah.
Lenders, they're, see, well, if you're equitable before, yeah, they're all sketched out with risk, all that's pulling back across the board.
Yeah.
Are you finding that in commercial as well, or are certain sectors still,
Yeah.
still okay with more risk because of like what you presented before with growth in those industries? Or is it like the residential side where across the board, everyone's sketched out and pulling back on risk?
Everybody's pulling back. Because it's the uncertainty of what's happening, right? So the banks have their own market analysis guys. They do that heavily. They have to,
Yeah,
right? This is
for sure.
to meet compliance regulations. Also, we look at external stuff when we're in the banks. And these guys kind of do their nerdy stuff and they basically tell me what's what, right? So, but yeah, so what they end up doing is, on the credit side, we don't tell people what we're doing. We don't advertise as a banking head, I'm talking now, okay? That my bank doesn't want to do these things, because that's bad PR,
No, you
right?
need
So
to-
we
you need
just
to bring them
shut
in
up, we
more.
just don't say anything. When the deals come in, we stress the deal. That's how we work it. But you need to know what's gonna happen, right? But because I'm connected, I just call these guys and say, hey, what's happening? Have you seen this? Are they stressing something? Yeah, they're doing this, they're doing that. So now I know where, I'm not going there, I can go here, I can go here. But that takes someone, like an account manager, know who I am and what I've done to say what actually is happening, right? Others, they don't wanna really say much either, right? But yes, it stresses. So generally what they'll end up stressing is the LTV, the loan to value. They'll end up stressing that right off the bat. Like as the market starts, you'll see that it'll be difficult to get to 75, or it'll be difficult to get to 70. It'll be harder to do that. So the sponsorship has to be stronger. You know, the capital has to be stronger. The history of the sponsors has to be stronger. So stuff like that will come into play. The other thing they'll stress is the components they may put in. The vacancy rate they'll stress that, or the maintenance they'll stress that, or they'll stress something along the way, and depending on what the asset class is. So that's how that sort of works. Same thing in residential.
Sorry.
Yeah, they're stressed in different ways.
Sorry, what is DSC? You mentioned DSC.
Debt coverage ratio. So if you have an income generating property, there's a ratio that we use to basically see, like some banks, like you can go to lenders like lenders will go to below 1.0. 1.0 is a break even. Okay, so and most major banks, depending on asset class, it would be anywhere from 1.2 to 1.35, and depends on geographical location as well. So you need to know kind of where this thing is going. Like office right now, I'm only interested in office. If it's an office for self, yes, it's doable, because now it's based on the financial statements and the creditworthiness and the strength of that particular borrower. I like those. Those are good, because usually you have a bakery, I had a bakery that wants to go in from renting to buying. Great, you've been around for 16 years. Your financials look decent because they're usually review engagement. We're good to go, right?
So you mentioned that they stress test loan to value.
They'll stress everything.
They stress test
anything they want to stress.
I'm
Like
curious, how do you stress test LTV?
you just knock it down.
Oh,
You don't stress it.
just
Say,
like
yeah,
that.
no, but we can go up to 75. Yeah, but for you it's 65.
The ad says 75, in reality
Yeah,
it's
your sponsor's kind of weak. It's not. He doesn't have 5 million in his bank. 65.
I mean, we used to work in bank, but we never did that actually.
At our levels, we do.
Oh, yeah.
We push it down.
What
We push it
level?
down, and you guys just do what was in the end. Yeah.
Oh,
Yeah.
okay.
So we'll basically tell our guys. They'll tell their managers, and the managers, oh, I'm not comfortable with this. That's how it kind of works.
Oh,
I'm not comfortable as a stressor, right? Like, because they're trying to get it passed, and if I'm seeing these things coming up, I'm like, no, I don't want this at this level of this asset class, bring it down. And then they'll kind of go down the chain. But they don't say, I said that, otherwise they're in trouble. They just say, okay, you know, we're seeing this environment, and that's how it basically works.
You mentioned something, the phase 2 and phase 3. Like, what's the difference between them?
Phase 3 goes even more deeply than phase 2, because they have different levels of tests and and details and data that they should collect. This is phase 2. Usually when there is phase 2, phase 3 will come after that, immediately.
But what's the difference? Like, what do they?
There is no,
So,
yeah,
yeah,
major difference.
I'll assist
Yeah.
Homa on that, hence why we partnered together. Phase 1 is a general, like,
Yeah.
almost all commercial properties, I mean, unless you have a commercial property in this
Yeah.
building, will need a phase 1, for the most part, especially standalone buildings, right? Phase 1 is just like a historical, know what of that land, what was used on it, what was not, what's contamination possibilities next to it, around it, maybe 60 meters either side of it, depending on the ESA guy, environmental guy. So if they say that there could be some contaminants, they could have been, they were storing coal back in 1950 on this thing, and have had that downtown. They can't do anything downtown, by the way, like all those mixed, it's grandfathered, in a sense. They'll say a phase 2 is necessary. So phase 2, they have to go drill boreholes, and they take that dirt, and they go to a lab, and you get this nerdy report, which I ignore, and I just go to conclusions, because I don't know what these matrix say, you have to meet the ministry guidelines, but they'll tell you, and they'll break it down as to, for a layman to understand it. Once it meets it, you're good. If it doesn't meet it, now you have remediation, which is phase 3 and more, okay, which can cost a phenomenal amount of money. So I would recommend anybody buying a standalone, you need to have a phase 1, or at least an existing phase 1, to see if there was nothing there. And then you have some assurance, which you still should do it. Because we may ask for it as a bank, we'll probably ask for it. Because what happens in ESAs, contamination, the lawyers love suing everybody. They'll say, oh, Mrs. Smith owns this property, what does he do? He ain't that rich, but you know what, that bank is really rich, so they sue us, right? And we don't want the publicity, so we just pay it, and that's what ends up happening. So we're very strict in the phase 1s. I had a client, I used to be a senior manager for CABC in the West, I managed $100 million construction projects. So we had one guy buying this land. It's in the city now, okay? Shell owned it, Shell owned that whole area. I don't know what they did on it, but major contamination on it. So they can't do it. I said, told them, go contact your lawyer, contact Shell. Shell comes back to me and goes, okay, we'll clean it. I said, how much is it gonna cost you? We go, oh, it'll cost us $1 million, we'll get it done. Okay, $1 million remediation, just for this one little piece of land. But it's Shell. $1 million is nothing. They just clean it and sell it and off they go. It's just part of cost of their business. They know that, right? So these things, a small apartment building I had in Port Hope, maybe 6 units, back some contamination. Cost that guy $150,000 to clean that. So that's not cheap. So environmental, be careful.
How recent of ESA would you be comfortable with?
Depends on the lender. Yeah, depends on the lender.
But if it's just a few years old, say.
That's too old.
Too old?
Yeah, they may want another one.
If it's
2019,
a non-environmentally sensitive business, or you've already determined in phase 1 that there hasn't been any environmentally sensitive businesses, even it's a 5 years or 10 years. I've used like ESAs backdated like 4 years or 10 years, because the history on the property doesn't deem anything that have changed from the past, so you can build the argument with the bank that nothing's changed. So we've done the ESA, let's say 5 years ago, and it's clean, and let's say the business that's there is like a property that's already built, so, and there hasn't been anything in the surrounding that changed, you can still use the same
So,
report.
yeah.
I'll give you a specific example.
Sorry, and this will be the very final question because we're
Oh,
over time. But
sure,
go ahead,
sir.
yeah.
So, I just got something under contract, a multifamily, and we just received the phase 2 part of the due diligence package. It's from 2019. Phase 2 is clean, no issues. And we're gonna be doing a site visit next week. But I'm just wondering, it's a multifamily conversion from a motel. Would like that
So
report?
it's an existing motel?
It-
Has it been converted?
No.
Okay.
Well, it's been converted, but not through the city yet.
Oh, so it's not zoned?
No, so we're gonna be going through that process, and that's where the value add is for my clients, right? So they
Okay.
wanna go through that process.
Okay,
And
so a lot of times, depending on your lender, the B lenders might be somewhat okay with that with projected, but A lenders, they wanna see that the plan approval is there, your city license is already there, because the now that value is there. That property can be deemed to be, and authorized to be multifamily.
Right.
Otherwise, they have to lend it on a hospitality.
Mhm.
Good luck with that. That's hard, today's hard.
Yeah. Well, the goal is to go through all that during the,
So they'll purchase it, might be private or B, and then go through the,
no, we're gonna do our due diligence, and then once we can determine that we can do the zoning and everything, rezoning and everything, then we'll do it until closing, we'll do all the conversions and everything.
oh, that could take a year,
Okay.
Yeah.
Okay.
So we'll continue that conversation offline. Thank you so much for your
No problem.
presentation. This was really
Pleasure.
helpful.
Then-